Everybody wants the best mortgage interest rate. A lot of people think it's just your credit score or timing the market and hoping rates drop. But in reality, there's over 20 factors that affect interest rates. Today, I'm breaking down the ones that actually matter and how to use them to your advantage. When people ask me what's the best rate I can get, that's actually the wrong question. The better question is, what's the right loan for me? Because the truth is, the best rate depends entirely on your situation and circumstances. Some of the factors you can control and some of them you cannot. So let's walk through the ones that actually move the needle. First is loan term, 15 versus a 30-year fixed. A shorter term usually accompanies a lower rate, but a much higher monthly payment. What most people don't realize, you can take a 30-year and pay as though you're on a 15. That gives you flexibility, a lower required payment, but the option to pay more anytime. Most people want the 15-year in order to have less interest over the life of the loan. But the 30-year, paying as though you're on the 15-year, gives you the flexibility and the option to have a lower payment. So if your circumstances change and you need to make the lower payment, it gives you that option. So a better rate doesn't always mean a better loan. Next, credit score. Yes, your credit score matters, but not always in the way that people think. There are tiers: 580, 620, 680, 740, and even 780. And once you hit certain thresholds, the difference starts to level out. Loan programs can also offset credit. For instance, government loans, VA, FHA, USDA, can price differently than conventional financing, even at a higher credit score. Someone with a lower credit score could still end up with a competitive rate depending on the loan structure. Timing matters here too. If you're planning to buy, don't wait until the last minute to fix your credit. Sometimes trying to perfect your credit before purchasing is counterproductive. For example, we are in March of 2026. If you were trying to purchase in January but wanted to work on your credit, rates have risen 1/4 to 3/4 of a point across loan programs due to the market circumstances. Now, down payment. Most people will assume the more you put down, the better your rate. Although this could be true, it's not always true. There are different pricing buckets: 0 to 3% down, 5 to 10% down, 10 to 20, and over 25% down. Sometimes putting slightly less down can give you better terms depending on the loan program. Often, first-time homebuyers with 0 to 3% down can get better pricing on interest rates than somebody owning an existing home putting 5 to 10% down. Avoiding mortgage insurance with 20% down can sometimes get you worse pricing than with 15% down and a low mortgage insurance premium. What you're buying also matters. A single-family home can have different pricing than a condominium or a multifamily home. Condos and multifamily units often come with higher interest rates. So two people with identical financial profiles can get two different rates depending on the property type. This is a big one. Loan program. You have government loans, FHA, USDA, and VA loans. You also have conventional loans, which is your standard Fannie Mae and Freddie Mac loan. You also have different purchase types, such as investment properties or second homes. Some programs offer better interest rates, but higher upfront fees. And you have to qualify. There can be income limits, location requirements, and other specific guidelines. So again, it's not just about credit and down payment. It's about all those things structured together. And then there's the one thing you can't control: the market conditions. Interest rates fluctuate daily based on the economy and debt markets. There isn't a best rate, but there is the best strategy for you. All of these factors work together: your credit, your income, your loan type, your property type, and timing. And when you structure them correctly, that's how you get the best outcome. So if you're planning to buy over the next 3 to 12 months, this is the time to start. Not when you find the home, but before. We can help you map out a game plan step by step, so when you're ready, you're in the best possible position. And remember, Aaron does mortgages.